Given what we've seen in Australia, in India, how much room is there for a hawkish surprise out of the Federal Reserve today?
Well, it's possible, of course, but I mean, the Fed's language has been extremely hawkish, really, for the last few months. Really since the minutes in early January, they've been dialing up their rhetoric, culminating with discussions of potentially a 75 basis point hike from one or two governors over the last few weeks, and a sense that QT is about to happen and about to be announced later on today. So I think, if anything, there's a bit of a risk of a surprise the other way. The market's been teed up to be very hawkish, to expect hawkish commentary. It's had a lot of Jerome Powell banging the drum along with all the other governors. And I think there's every chance that they may feel they've priced a lot in, and they may even just dial back a tiny bit. Not much necessarily, but a tiny bit.
So, Chris, is what you're suggesting, though, that if they were to move 75 basis points, the market would be fine with that?
It depends how they do it. If they move 75 and make it a statement and it allows them just to ease off a bit in terms of rhetoric or something, or they do 75 and they make acknowledgement that there's some softening of growth and therefore inflation is likely to follow. It depends exactly how they do 75. If they just do 75 and say, actually, we're more hawkish, we're going to do another 75 probably in a few months' time, then that would be taken poorly, I think, in terms of, it's a doubling down on that hawkish rhetoric. But as I say, if they do it with a sort of a slightly dovish tilt, and I wouldn't want to over accentuate the word dovish, but if they do it with some conditionality, as I say, something softening on growth or something like that, then actually the market may take it okay.
Okay, that's interesting perspective then. Interesting to, absolutely flag that it depends how hawkish or dovish they are in the commentary that goes along with whatever hike they do deliver then, Chris. Let me ask you about a growth focus. What do you think we will hear from the Fed around the strength of the US economy? Because that's crucial in terms of the market's assessment of how many hikes the Fed thinks it will get done during this cycle.
Yeah, I mean, I think there's an argument that they might talk about the temperature being a bit cooler, certainly in terms of growth. So, we had ISM new orders again the other day. Over the last couple of months, they've softened pretty sharply. Housing's coming off its hottest temperature, if you like, and there's a bit of softness there in mortgage apps and things like that. So quite a few parts of the cyclical part of the economy are feeling the effects a little bit of higher rates already. So there's definitely an argument that they may dial down the discussion of the strength of the economy. Payrolls remain pretty good, but those other parts, as I say, payroll's a bit of a lagging indicator. Those other parts have seen some softness. So I think that's really a key area to watch tonight, what they say about the economy, the update on that, and any comments along those sort of lines.
What about the international influence here, Chris? I mean, clearly they set policy for the US market, but it is influenced by international factors. I'm thinking about Chinese growth. I know that Bloomberg Economics have been asking whether weakness in Chinese growth might actually slow the pace of hikes from the Federal Reserve. They say it's too soon for that to actually happen, but it's something they're thinking about. Is that a connection that you think the Fed will increasingly have to look at as we go through this year?
Maybe as we go through this year. I don't think, personally, I think what we're seeing in China is an easing cycle. So we're going to get an acceleration of Chinese growth. And in that sense, it's in a completely different place to what you see in the US and other central banks in the West. But I'd be very surprised if they made even a hat tip towards the Chinese housing market tonight. I think it's all eyes on US growth and all eyes on the outlook for US inflation, and all eyes on how hawkish the Fed feels it needs to be and whether or not it feels it's done enough heavy lifting and jawboning of the market, which is really what it's been up to over the last few months. So yeah, I mean, China may feature later in the year, but I unless it falls apart sharply from here, which, as I say, I don't think we expect, then I don't think China will be a main focus of tonight.
Chris, we're talking about a historic rate hike here, the first 50 basis point hike priced into the market since May of 2000, 22 years. But I have to ask, what is it going to take for the Federal Reserve to start easing again?
Great question. I mean, I wouldn't be surprised if we got a cut next year. That's not impossible. Now, that would come after a whole series of hikes this year and some quantitative tightening. I mean, the interesting thing is what we're doing is we're unwinding, firstly, funny money. We're moving back to what I would call normal monetary policy from easy. And then the question is whether you start to move towards tight. And certainly the pace we've seen from the Fed, the language we've seen from them, I think means that once we get towards the end of this year, there's going to be some pressure the other way for 2023. There could be some real challenges on growth. There could be some challenges in the way financial markets behave. There is a bubble in the US financial market. It's perfectly plausible that it's popped by expensive money later this year. Some would argue it's already popped. I'm not convinced that's the case, but there's definitely an argument that later this year that comes to pass. And therefore, 2023 could actually see a cut. So, we need money to get tight first, but then you could easily get to that stage where, as I say, next year, the Fed's actually looking the other way and moving the other way to try and offset some of the downdraft from financial markets deteriorating and from some softness in the economy.
So a potential cut in 2023, but then you add on European sanctions, an oil import ban of Russian oil, calls that on Wall Street have really been made for as much as high as $200 oil on the back of that sanctions package. Does that prolong the 2023 cut in your view?
No, because I think the growth of money supply is already slowing dramatically. It's, if you look at M2 money supply growth, it was 25% or so last year. It's now down under 9%, 8-9%. It's slowed very sharply and it's slowing sharply. That's the trajectory. And if that continues, what will happen is an oil price spike will be deflationary, not inflationary. Remember those days? Back in the old days, we used to say when oil price went up, it slowed the economy, it was deflationary. Now, because there's been so much money around in the last 2 years, it's been inflationary. But I think if you roll forwards, you'll find into 2023, it's back to the old deflationary style because money supply growth is slowing. And if the Fed keeps doing what it's doing, it's going to continue to slow. So there's less money to go around, and that's the way oil price plays out. By the way, I'm not convinced oil goes to 200 anyway. I wouldn't be surprised. I realize there's a sanction risk, but I wouldn't be surprised if we'd already had the high in the oil price on March the 7th.
Interesting that we only, in inverted commas, got as far as 108 on Brent today on the back of the EU's oil announcement. Chris, thank you very much for joining us. Chris Watling, CEO and Chief Market Strategist at Longview Economics.